The S&P 500 slipping this week, but still just a few percent away from record highs. So how do we know which way stocks are going next? Welcome to Trading Nation. I'm Courtney Reagan. Matt Maley is with Tabak, and Mark Tepper is with Strategic Wealth Partners. Matt, thanks so much for joining us. We're going to start with you. You're looking at a key level on the chart. Can you walk us through what you're watching?
Well, obviously we've finally seen a little bit of a weakness here with all the issues going on around the world and in Washington, D.C. And, I've been watching the closing lows on the S&P 500, I'm sorry, the closing lows from March. And we've actually broken slightly below those today. So the next key level is going to be those intraday lows from March, and that comes in at the 23.22 level. And then below that, we have the old highs. Whenever we get a key resistance level and it's finally broken, and that's what happened at the 22.88 level. That was kind of where we kept bumping up against in both December and January. And when we finally broke above it, the market took off. Well, that old resistance is now support, and it's also a Fibonacci 38.2% retracement of the entire rally from November. And then finally, the most important level, and that's only, again, this would be if the market really starts to roll over, but the 200-day moving average, that was incredibly important support right after the Brexit vote. We got below it for one day and bounced right back. And then right after the election, the U.S. election, we got right down to it and bounced strongly. So if for some reason, whether it be problems in D.C., Korea, French elections, if we broke that 200-day moving average, that would be a big problem, I think, for the momentum players and could cause some problems. That's certainly not my base case, but it's something we have to be aware of.
Okay, so you're looking at a key level. Mark, how about you? Are you looking at anything more fundamental? We're going into a long weekend. Does that change your viewpoint?
Yeah, so we're definitely more fundamentally oriented. And, I would agree the market is certainly ripe for a pullback at any time, especially if tax policy and infrastructure spending end up disappointing. But the overall trend is still positive for stocks. And, here's why momentum is going to continue to really take stocks higher. Believe it or not, there's still a surprisingly high number of bearish individual investors with cash over on the sidelines. And in order for us to get that cash back to work, we need to start to see some top-line revenue growth, which we really haven't seen for the last few years. However, there's reason for optimism because companies are now seeing a revival of pricing power. So the majority of sectors and industries are now finally able to lift their selling prices since the deflationary pressures have declined so much. And then large companies are really more likely to correlate with global GDP growth than with U.S. GDP growth, and that's supposed to accelerate to 6% this year, up from 2% last year, which should be a tailwind for revenue growth. So, we do think that stocks are going to be moving in a positive direction over the course of the next year and beyond.
All right, there's a lot of things to watch here, both fundamental and technical. Thank you both for joining us and walking us through both of your theories, Mark and Matt. Thank you all for joining us on Trading Nation. I'm Courtney Reagan.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.